So we should be live. This content of this meeting is being sent to a custom live streaming service. So let's see if it's actually working. There we are. Okay. Awesome. Okay. Technical challenges, as always. Anywho, we have today is Tuesday, and it is the 19th of November, which means we're coming up on the end of the year, and this is the $1 Trillion Show. So well, let me just dive in. Actually, I've got a whole thing that I prepared as for what that means, the $1 Trillion Show. All right, so let's jump in here. So this is the $1 Trillion Show with your host Neal McSpadden. On the line here, we've got Serena, we've got Fatma, key members of our team, and our goal is to save Americans $1 trillion. Now that sounds a lot, and it is. That's about, as of last year, that's about a quarter of the tax revenue that the government has raised. So, we want to make a significant impact on the tax burden of America and Americans. So, that's the mission. And how we do that is by scaling tax savings strategies through technology. So obviously, we're Tax Sherpa. We have our own clients that we deal with on a one-on-one basis. We have our group. We have the explorers and the navigators, which we deal with on a one to several basis rather than one-to-one, like our one-on-one clients. But we're not going to get to $1 trillion with just those. We don't have enough time in the day. So how we do that is by scaling technology. And technology takes a lot of forms. So one of the things that I'm working on, in fact, I was working on earlier today, is things like, well, like the starter course. So that's this guy that I've been working on today. And the starter plan is what we call the people who can utilize tax strategy, but it's in this in-between phase where it doesn't make sense to pay a full service firm like us, several hundred or sometimes several $1,000s a month to do this work for you, because the net tax savings is not large enough in order to afford that. Because when we work with clients, we're always adding value. We always want people to make multiples of whatever our fees are. And some people, their situation just doesn't work just because of the character of their income or the amount of their income or what have you. So what the starter plan here is for is people in that situation where there are things they can do, but the dollars don't pay in order to hire somebody to do it for them. So that means it's a do it yourself kind of scenario. And we have the knowledge, and we're going to give people the knowledge of how to do that, along with the templates and the worksheets and everything. As far as if I have a day job and I make 100 grand or 80 grand, I think the median salary right now is like 64 or something like that, and median households like 78. So if you have that level of income, then you're paying taxes and you have things that you could do. And what the starter plan does is it guides you through those different things and how to set up things correctly, document things correctly, and then take advantage of the tax law so that you can reduce your overall tax burden. And so this is an example of the technology that we can apply to everybody and get the knowledge out there so that people can make their own tax situations better. So I'm perfectly happy for people to save $5,000, $7,000, $8,000 a year just by implementing basic stuff in the starter plan. But people don't know what they don't know. So we have to go through and educate people on how to do all those things. So that's kind of the how this is all starting to come together in terms of what we do in order to scale those technologies to the wider populace so that we can save $1 trillion, because that's our guiding star is the mission. So Who am I to be saying all this stuff? Well, I'm the guy that was getting letters saying I owed the IRS, $1.3 million dollars. It's funny. Every time I tell people that, and this happened today. So we recently purchased a firm here locally in Atlanta, and we're in the process of reaching out to clients and telling people about the transition, and we're reviewing their files and all these kinds of things. And I spoke to one woman today, and I was telling her how I got into the business, and I got into it because I had my own problems. So so when you start getting letters from the IRS saying you owe $1 million, several things start to happen. So thing number one is you go into panic mode, and thing number two is you go into stick your head in the sand mode. And it took me 2 years to start cleaning up my tax issues, and then it took another year to actually fix them all. So this was all a long time ago at this point. Um, and that's how I got into the tax world, through my own issues. And ever since then, I've been focused on the strategic side so that we can save our clients, uh, you know, whether it's $1,000 on their taxes a year or $1 million on their taxes a year. And I've done the whole spectrum of that whole thing. And then, every dollar that sits in your pocket and not in the government's pocket is a win for me. So that's 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 how I come to this, how I approach the whole tax world. Um, so yeah, that's the background. All right. With that said, let's jump into. I'll give you a little preview of the starter course. Um, so there's a couple. This is do-it-yourself tax planning, and um, there's a couple pieces that are common ground. So so thing number one is everybody in America should have an LLC, which sounds ridiculous, but it's true. And the reason for that is that everybody I talk to, and this is over, I've worked on over 50,000 tax returns over the years. And every time I talk to a new client and I start asking them questions, 98% of the time, there is something beneath the surface there, from a tax perspective, that is not being utilized. So my favorite question when I talk to people with day jobs is like, okay, you go to work and you come home. What do you do when you're not at work? And then I just let them talk. My favorite question, because I hear all kinds of answers. And what I concluded from that is that just about everybody has some kind of side hustle going on if you have a day job. These days it's easier than ever. You can just sign up on Uber and you can, deliver Uber Eats, or you can give people rides or whatever. That kind of super easy stuff did not exist, 15 years ago. But but everybody's doing something. I've had people. Um, I was in South Florida for the first part of my career, and so it was a lot of South Florida type stuff. So we had people raising snakes. We had people growing coral in their garages and selling it to saltwater aquarium people. Um, I had one woman who would teach cooking classes, and she'd go to people's houses and teach them how to cook. Just all kinds of stuff. And what's so fascinating to me about that side hustle is that is usually what people are actually passionate about. It's like, yeah, you have your day job. Very few people are super excited about their day job. I am. I actually love what I do, but I've created my day job. I didn't just go to work for somebody else. Um, but most people are at work to make money, and that's kind of it. But the side hustles is where they're really interested in. And I have that to my own self as well. I've been really interested in like regenerative agriculture type stuff for a long, long time, doing aquaponics and worm bins and all kinds of stuff. But on a hobby level rather than a true business level. But everybody's doing something is the upshot there. And so everybody should formalize that and actually have an LLC to manage this business activity. And 92% of the time, that LLC should elect S corporation treatment. So what that means is a couple of things. So one is that it files its own tax return. It's not part of your personal tax return. So an S corporation and a partnership and a C corporation, all of those file separate tax returns from the owners. And that's important because it pits different IRS departments against each other, which simplifies your life significantly. Um, And there's some formalities that you have to go through with an S corporation. There's a form that you have to file. And the next part is you have to manage your bank account. And in the business, you need a business bank account. Now we work with Relay Financial. They're fantastic. They have very, very easy bank accounts. There's no minimum balances and there's no monthly fees, which is the two biggest problems with business bank accounts. And they're nationwide and it's super easy to set up because you fill out your information, they send you a text on your phone, you take a selfie, you take a picture of your driver's license. The whole thing takes like 5 minutes to set up, which is fantastic. And then you have to manage your basis. And I don't want to get into a whole thing about what basis is, but basically it's the net investment you have in your company. And that's important if you're taking deductions, especially for you day jobbers out there. Um, and then there's three basic strategies that every company should employ, including your own company. So one is an accountable plan, and that's a reimbursement strategy where, if you've ever had a job where you went on a conference and you had to give them receipts so that they can reimburse you, that's an accountable plan. That's just reimbursements for business use of personal funds. And there's a whole series of different things that you are using on the business level, but you're spending personal money on. And that training goes through how all that works. And you're able to create reimbursements to yourself that are expenses to the business, but not income to you because they're reimbursing money you've already spent. Health reimbursements, there's different flavors, but basically you want to be taking health expenses at the corporate level rather than at the personal level. Personal level is not as deductible. There's a whole thing as to why that is, but yeah, so you want to get deductions out of your out-of-pocket medical expenses. And then summit strategy sessions. So summit strategy sessions are our version of, you might have heard of the Augusta plan or the Augusta strategy. So effectively, you can rent out your personal dwelling up to 14 times a year, tax-free. And it goes back to 1976 with some rich guys who lived around the golf course. But basically, that's the summary of it. Where people screw it up is in two ways. They screw it up because they don't have the right number in terms of how much should that rental cost. And the way to do that is to actually do market research, and we'll show you how to do that. And the second thing is not having a business purpose. And they just say, oh yeah, yeah, I rented it for business. I had a party or I had a whatever. But it's like, no, yeah, the thing that the IRS gets people on most of the time is documentation. So we'll show you how to actually document your meeting and what to actually do during that day so that yeah, I mean, you have the tax strategy, that's great. But more importantly, you have the process by which you are reviewing your business. And what that does is it actually makes you have a better business over time. So that's critical. And then the starter plan diverges if you have a day job or if you're a true small business owner. And there's different considerations in those different groups. So if you have a day job, you're going to be probably running at a loss after everything's all said and done. There's considerations with how much of a loss and how to manage your basis and all this kind of stuff in order to avoid red flags and keep things humming along smoothly. And then if you are a true small business owner, whether you're a freelancer or a 1099 contractor or just an independent person, then there's different considerations there. And we dive into each of those separately. But that's the starter plan. And you know, effectively this is do it yourself basic tax planning. And you can if you're an average person, you can typically save yourself 5 grand, 8 grand, 10 grand, something like that every year. So it's definitely worth doing. Now, this kind of thing is one of the resources that is included with our navigators, which is our premium group. For our explorers, it's going to be a small fee. I'm thinking like 20 or $30, something like that. But definitely worth doing and understanding how these different pieces work together uh, in order to keep money in your pocket and not the government's and add to our $1 trillion. You know, that's what's in it for me. You know, at some point we have to start like keeping track of how much each person is saving. that's going to get difficult as we distribute this to the masses. But Serena, what do you think? Should people report in as like, well, I was going to pay this, but now I'm paying this, and figuring out that savings there?
Definitely.
Yeah. So yeah, this is technology that we're working on in order to get to our $1 trillion, basically. All right. So enough of the what. Let's dive in. The other thing that we do here every week is questions, because everybody always has questions. Everywhere I go, whenever I say, "Oh yeah, I do taxes. I help people save money on taxes," it's just nonstop questions wherever I am. But I have the answer. I have the answer to every tax question that there is, and the answer is it
It
depends.
depends. Yeah.
And it really does depend. And it depends on facts and circumstances. And what that means is that what is true for your particular situation may or may not be true for somebody else. I spoke to somebody today talking about IVF and the costs involved there. And it's like, and we were talking about, is that a medical expense or is it not? And what it comes down to is that, is it elective um, or is it medically necessary, right? And what you have to compare that to is like normal bodily function. So normal bodily function is, yes, people are able to have children. So IVF is actually restorement of a normal bodily function. Therefore, it is, medical expense. Now, how you treat that medical expense depends. Depends on your income, depends on whether you're itemizing, depends on if you have a company, depends on if you have a company reimbursement situation. All these things depends. But that's what it comes down to. So Serena always has a pile of questions for me that we can go through here.
Mhm.
And so the let's dive in.
Um,
We do have a question on the chat. Serena, do you have the chat open? I don't know if I actually sent you the link or not.
I
But
don't have the link.
yeah, but missed the first 15 minutes. Will this be repeated? So yeah, so the we do this every week, but it's different every time. But yeah, if you're on the YouTube stream, that they'll keep a copy there and you can rewatch it once the live stream is over.
Mm.
And then as Fatma here does a lot of our video editing, and then it gets posted separately later on when it's trimmed up and all that kind of stuff. So yeah, there is stuff to there are ways to review everything. So have no fear. Everything on the internet is recorded forever. All right, Serena, what do we got this week?
So we have someone that wrote in and asks, "What's the smartest way to handle taxes if you receive an inheritance or a large one-time payment?"
Well, those are two very different things. So
Yeah.
so inheritance typically is not taxable to the recipient. Typically, there can be situations where it is, but it's
Mhm.
pretty weird. So inheritance comes in with the what do you call it? With the estate tax. So this is, you might have heard of the death tax, and this is an issue with Trump getting reelected. So round numbers. Before Trump got into office the first time, the estate exclusion was about 5 million bucks. And for a married couple, which most people who deal with estates do end up being married, which is an interesting correlation. But so typically the wife lives longer. So husband passes away, leaves less than $5 million to the wife, and then the wife gets um, a combined exclusion of 10 million. Okay. So the Tax Cut and Jobs Act back in 2017 basically doubled that, and plus a little bit more, and raised it to $11 million. And it gets adjusted every year for inflation. So I think we're up to 13 at this point. So if your estate is less than $13 million, then it's going to be under the estate tax exclusion. Some states have lower exclusions, so you got to watch out for that. I think New Jersey's 2 million, something like that. Um, and then uh, the heir. So if it's under the exclusion, the state doesn't pay any tax. If it's over the exclusion, the state does pay tax. But then the recipients of whatever's left after taxes are inheriting that tax free. Um, so that's the typical arrangement. like I said, there can be weird things if you don't do your estate planning correctly. So we had one client that we talked to last week where he's got a company that's been running for, decades. He wants to give it to his kids while he's still alive. And he wants them to become more involved and take over ownership. And he wants to gift them shares. And we talked to him, it's like, well, you can do that for sure. But you have problems in that, when you gift them, then, you are gifting them at your basis, which is zero, right? Because he started the company. So the uh, so the so the so the kids do not benefit from the step up in basis. And so we laid out all the different options. But it's like, well, it's way better if you just like get a market valuation and just sell them, whatever the shares are. Then they have their cost basis at that new number, and then you could finance it or whatever to spread it out over time. But the uh, but that avoids all those problems where if you got this asset before the person passed away, then there can be tax implications because you're taking their basis rather than your step up basis. So that's a whole issue. As far as large one-time payments, well, I mean, depends depends on what it is. If it's an inheritance, then same rules apply. But if it's something else, then yeah, typically you're going to want to run that through a company of some kind because typically that's where one-time payments come from. Um, I guess I'd have to know more about the situation in order to give a more in-depth answer.
Right.
But
I was going to say the same thing.
yeah,
Same thing there.
all right.
So we have another question for real estate and property taxes. Someone wants to know, how does owning a home impact your taxes and what deductions are available for homeowners?
Yeah. So personal houses are deductible slightly. So first you have your real estate taxes. Your real estate taxes are part of your itemized deductions. So if you look at Schedule A, uh, the first part is medical, and that's for medical above 7.5% of your income. Second part is state and local taxes, SALT is the way that's shortened. And that's where your property taxes go. That's where your state income taxes go. If you don't have state income taxes because you live in Florida or Texas or whatever, you can put in state sales taxes. Third category is going to be mortgage interest. Mortgage interest for mortgages $750,000 and less in terms of balance. Next category is charitable contributions, and then there's kind of the miscellaneous other for disaster losses or gambling losses or stuff like that. So under the current system, which is the Tax Cut and Jobs Act regime, um, most people are no longer able to itemize, meaning that when you add up all those different things, then the total is less than the standard deduction. So for 2025, they just announced the numbers. For single filers, the standard deduction is going to be 15 grand. For head of household, I think it's 21, and for married filing joint is 30,000 and married filing separate is 15, same as single. So basically, your medical above 7.5% of your income, plus your state and local taxes limited to $10,000, plus your deductible mortgage interest, plus your charitable giving, has to add up to be more than those numbers, more than 15,000, more than 21,000, more than 30,000 before they even begin to count. So because of that, it's most people are not able to itemize unless they have a huge mortgage interest or they have huge charitable giving. And then in bad situations, you have huge medical expenses. So, um, so if you talk about your personal home, property taxes and mortgage interest go into that calculation, but because it's hard to itemize overall, you're probably not going to get anything out of that for most people. Um, so ways to for investment property for a house you don't live in, that's not true, and all expenses are directly deductible against that income from the rent. Um, but for personal property, that's it. Now, the exception to that is that, if you have a business that you're running out of your home and you take a portion of your square footage, then you have home office expenses where you can take some of those indirect expenses. And there's ways to do that through home office or business use of the home, which is your Schedule C. I recommend not doing it that way. Instead, do it through an accountable plan. Much better, much safer. So, so there, in that way, you're able to take a portion of your property tax, a portion of your mortgage interest, a portion of your insurance, a portion of your HOA fees, a portion of your utilities, and those other things are not deductible at all as a personal residence, but are deductible for business use. You just have to do it right. And if you go through the starter plan, we'll show you how to do that. So in that way, you're actually able to get some bang for your buck out of the personal property expenses. However, here's where people screw it up.
Right.
This is all under home office type stuff, and home office has two requirements. Requirement number one is that it has to be regularly used. Now, regular is easy. I do this twice a week, 3 times a month, every day, whatever it is, regular. The second part that people have a lot of trouble with is exclusively. So whatever square footage you designate as your home office has to be exclusively used for office business purposes. And so there have been all kinds of crazy court cases about this. So in one case, a guy was a lawyer, had an office in his house, saw clients in the house, well, totally legit. He installed a bathroom to be in suite, with his office, so he didn't have to go downstairs or whatever. And during a Christmas party that he had at his house, he let people from the party use his office bathroom. And that right there was enough to violate the exclusivity of the usage. And so they threw out his whole deduction. In another case that I think is, egregious, but is what it is. There was a woman, she had a baby, and she put a crib in the office, in her home office. And this came up during examination, and they determined, oh, that's personal, it violates the exclusivity, therefore we're throwing out the whole thing. And so, and that's even if you had a regular office, like outside your home, and you put a crib in there, that's still an office, right? Nobody's going to argue about the personal use of that, whatever, 4 or 5 square feet that the crib takes up. So you got to be careful when you define what your area is. And so one way to deal with that is to define your area very specifically. It doesn't have to be the whole room. So in my home office in my home that I was in, since COVID up until 2 weeks ago, my office was in my basement, but it wasn't the whole basement. It was about a quarter of the basement. And so, I just applied the square footage rules, as appropriately, and deal with it that way. So like with the woman with the crib, if she had cut off the square footage that she was counting for home office to cut around the crib, then she would have been fine, and it wouldn't have violated the exclusivity. So you just got to be careful, and the key guiding words are regular and exclusive, especially exclusive. So um, those are ways to deal with home expenses. But it sounds like a simple question, but it depends, and it gets into the nitty gritty real quick.
So that is a it depends question.
Yes, that is an
Right.
independent question for sure.
Understood. It looks like we have a tax planning question now.
Mhm.
Someone wants to know, is it better to overpay taxes throughout the year and get a refund or aim for breaking even at tax time?
So this is a philosophical question. Okay, so there's 3 scenarios. Well, there's 4 scenarios. So scenario number one, you overpay throughout the year, you get a refund. Um, you effectively have given the government an interest-free loan during the course of the year. Now, personally, I'm not a fan of that. There are situations where it happens, and it kind of is what it is, but that's not the goal, right? I've seen a lot of people use their tax refunds as sort of a forced savings account, where it's like, well, I know if I have the money, then I'm just going to spend it on whatever. So I'd rather hold it in the separate place where I can't touch it until once a year, and then I get a big check all at once. And yeah, okay, that has a place, I guess, and it depends on your personal makeup as far as whether that's a good idea or not. In general, not a fan. Um, so second situation is break even, where you've kept up to date throughout the year. You've done your projections. You've made sure that come January, which is when quarter four is due, then you have your numbers for the whole year and you can say, okay, my tax liability is X. Here's the last payment that brings me up to X. We're even Steven. I just got to file the final returns later on. That's fine. Situation number three is where if you typically owe money, then there are quarterly payments that the IRS wants you to make. And there are two different ways to do it, two basic ways to do it. So one is, the even approach where it's like, okay, you go through the year, like we're in November of 24, and we say, okay, the year is looking, in March, at the end of March, we're looking at this amount for the year. I make a payment in April. In the end of May, we're looking at this for the year, so I make a payment in June, and then in September, and then in January. But method number two is based on your prior year tax return. So let's say my total owed last year was $10,000. As long as I pay 11 this year through my quarterly estimates, then I'm not going to be penalized. But that does not mean that I'm going to be even when it comes to time to file taxes. It just means I've paid enough to not get penalized. So because different years are different, right? Especially for small business, can be wildly different. Um, so that's the safe harbor approach, and it's okay. I'm not such a fan of it. I'd rather do projections and figure out the actual amount owed, because the years are so different. There can be times where, okay, based on last year, I'm going to pay X, but then I made way more money this year, so I still end up with a huge bill due in April. Or last year was really high, this year not so much. So if I make these quarterly estimates based on last year's, I end up with this huge refund. Again, we're back to getting um, interest-free loan to the government, which I'm not a fan of. The other way is, not officially not recommended, but a lot of people do it, where they make no payments, right? And
Hmm.
they end up paying, at the end of the year, and the IRS will charge an underpayment penalty for it. And you can get yourself into trouble this way. There can be like forced withholding some kind of situations which you don't want to be in. But a lot of people, especially small business people, make the conscious decision. It's like, well, yeah, I know there's going to be a penalty. I'm willing to pay that penalty for the use of the cash during the year because if I pay 8%, which is kind of the current rate, it fluctuates with interest rates and stuff, but around 8% right now. Um, so if I owe 10 grand and with penalty, I now have to pay 10,800, I'll make that trade in exchange for the flexibility of having the cash during the year. If there's something I want to buy, if there's something I want to do with the cash, all this kind of stuff. So that's method number four, which is officially not recommended, but a lot of people do it. So um, so those are the different ways. If you had to pick one, I would go with do the projections and get an accurate payment in so that, come April when you actually file, or if you're waiting on K1s or something, September, October sometimes, then you're even, and you don't have to worry about paying and you don't have to worry about getting refunds. Um, so yeah, that would be the way I would go.
Alrighty, so it looks like we have a future tax concern. Someone wants to know, do you think tax rates are likely to increase the next few years, and how should we prepare for that increase?
Yeah, so we just had this election, right? And supposedly in January, Trump's going to be in office again. Now, Trump has talked about what he wants to do with taxes, and basically it comes down to he wants to make his last tax reform permanent with some modifications. And in that case, tax rates are going to remain the same. So, you know, the question becomes if, assuming everything goes as planned, will that get through the Congress? Because, you know, presidents can say whatever they want, but all tax bills have to start in Congress, be passed by Congress, and then signed by president into law. So the Republicans have a very, very narrow majority in the House. They've got a slightly larger majority, but still narrow in the Senate. But already there's talk in political circles about the Senate being run by guys who, even though the Republicans are not friends with Trump. So, we'll see. If the if the Trump plan does not get implemented for whatever reason, then the Tax Cut and Jobs Act is going to revert back to the way it was before 2017, and tax rates will go up. So that's where we are right now. It's very much to be determined with this upcoming administration.
Alrighty. So we have a general question, Neil.
Mhm.
Someone wants to know, for someone feeling overwhelmed by taxes, what's the first step you'll recommend to make this process less stressful?
Um, yeah, so the first step is to get your documents together. And what you're feeling stressed about, it really dictates what that means.
Right.
So a lot of people have past year issues, right? So it's like we talked to a client last year, we were talking about current year stuff. It's like, oh yeah, by the way, I also owe 100 grand on the last couple of years. It's like, well, okay, that's good to know. Uh, so, if that's your case, what you want to do is you want to start collecting transcripts. So if you create an account at the IRS, you go to irs.gov, and it says something like, oh, actually, I'll just bring it up here. I think it's get my records or something. It is sign into your account, get your tax record. This guy right here. Let's see if I can highlight that. That guy. So there are transcripts of different things that the IRS has on file for you, and it's by social security number. So you create an account. You have to have a one of those IDs with the star on it, so it can be real ID certified. So if you can do that, and it's better than it used to be. It used to be only about half the people could successfully log on, but now it's like 80% can successfully log on. Um, but if you're able to get into your account that the IRS has for you, then you can download transcripts. And there's different transcripts. There's a tax return transcript, there's a wage and income transcript, there's an account transcript, and there's one more that I'm blanking on, but there's four, and you can download them back going several years. And if it's older than that, then it's a separate process. But if it's relatively recent, then you can do it that way. And start putting those together by year, and you're able to um, get everything that the IRS has on file for you. So the tax return transcript is going to show you what was filed, on a tax return as far as the IRS is concerned. And it does not look like a tax return. It's just a bunch of text with lines and numbers. And it maps to a tax return, but it doesn't have all the different things that are on a tax return, all the details. It just has kind of like summary numbers. Um, and so that's thing number one. So okay, figure out what was filed. The other thing is the other most important one. Well, wage and income is what other people filed that relate to you. So if you have a W-2, your employer gives you a copy, but they also give the IRS a copy, and that'll show up in the transcript, in the wage and income transcript. If a bank account paid you interest, that'll show up in your wage and income transcript. If you traded stock, that 1099-B will show up in the transcript, wage and income transcript. And then the account transcript shows like, okay, tax return was filed, tax was assessed, amount was paid, refund was issued, whatever the case may be. And they're time stamped, and the timestamps are wrong, which is super fun. Um, but um, so the upshot of all that is that if you collect all those transcripts and you're dealing with a past situation, then you can take those and bring them to a professional and you say, okay, here's what I'm dealing with. What can we do? Is it just a matter of paying? And I did some crazy thing where I exempted my whole paycheck and now I owe money. Is that the situation? Um, or is there some kind of error where it can be fixed? That's always the best situation. If you can fix the error, then the whole thing goes away. Or it might be I just need to set up on a payment plan. Or it might be I need to maximize my refund this year. The IRS will take that and apply it to this past issue, whatever it might be. So that's for past issues. For current issues, you want to get organized in the sense that, again, depends on what it is that your life situation is. If you have a day job, that's usually taken care of for you. You want to make sure your withholding is correct for your filing status and for your total income. With day jobs, people get into trouble when they have other income that's not being included. So uh, let's say I have a W-2, I make $50,000, but I also have, I don't know, a business income of another $50,000. So my income is not 50, it's 100. And ideally, I want my taxes withheld on my paycheck to reflect the whole 100, not just the 50 that this job is paying me. And you got to work with your HR people in order to get that done. Um, if you have a lot of stock activities, buying and selling, do you have carry forward losses? What are you looking like quarter by quarter? All those kinds of things. You want to be on top of that. If you have a business, obviously the business is the mother lode of complexity. And the key first step there is getting up to date on your books, which sounds horrendously painful to most business owners. But it needs to be done. And there are strategies for dealing with this. So I'm a Profit First professional, and Profit First is a cash flow management system for small business. It's fantastic. And basically, what it amounts to is you set up multiple different bank accounts, and Relay is great for this because you can set up like the 20 or 50 bank accounts, all free. Super fantastic. Um, and when money comes in, it comes into one account, and then you distribute it to other accounts. You're going to distribute for tax savings, you're going to distribute for profit, you're going to distribute for money for you to live on, you're going to distribute for operations expenses. So you do all that, and then you know that the money coming out of your operations expenses accounts is expenses, and everything else is not. And that simplifies the bookkeeping massively because you're categorizing by account rather than categorizing by transaction. So at least you'll have a global understanding of what is happening to the business. Um, in other areas, if you have like rental property, then you need to be managing that, whether you're doing the management yourself or if you hire a property manager. Most property managers these days will be able to give you a report in terms of profit and expenses, revenue and expenses. And if you're doing it yourself, you need to be on top of those numbers as far as money coming in, money going out. Um, so yeah, it really comes down to being on top of the numbers, whether it's a past situation or a current situation. But that's where you start. Is what money is coming in, what money is going out, how are those things categorized, and are they taxable? Are they not taxable? You know that is the basics that you want to start developing in order to keep organized. And part of the difficulty is that every taxpayer is everybody, and some people are really great at organization and some people are really not. So if you're one of those people who is not, then that can be a real challenge. And you know, at a certain level, it's basically, you just need to hire somebody in order to do that kind of work for you. If you like temperamentally just can't do it. Uh, but short of that, those are the steps you'd go through personally to keep on top of your numbers.
So would you say this is a it depends question?
They're all a depends questions, but yes,
Right, right.
it
Right,
depends right there.
right, understood, understood.
Yeah.
So we have a question, Neil, about the flat tax system, right?
Flat
So
tax. Yeah.
yeah, flat tax system. What's your
Uh-huh.
take on the idea of a flat tax system? Would it simplify things or create more problems?
Both. So so it would simplify things and it would create more problems. So for flat tax, basically, and there's different versions that have been proposed over the years where you know you flat is good in that it's simple, right? So it's 10%, it's 15%, whatever the percentage is, it's simple. So like Estonia, I have read, has a 10% flat tax. And basically, when you withdraw money from the bank, they just give you 90% of it, and that's your tax. So it has that allure in that it's simple. We don't have to do all these different things and plan for things. The power of the tax system that we do have is that it caters to your customization and the fact that your life is different from somebody else's life. Um, so like if you're under that, withdrawal system like Estonia has, and you want to withdraw $1,000, they give you 900. It's like, well, okay, but what I was going to use it for was not like a business thing. I was just gonna pay for somebody to help me do something, and it wasn't like it was a personal hobby kind of thing, or it was just not an income producing event. And so, you depending on your particular numbers, you might end up paying more under a flat tax like that than you would under the income tax that we do have. So then there's the fact that flat taxes, the biggest criticism of flat taxes comes from the left side of the political spectrum in that it is regressive. And what that means is that there's a basic cost of living, right? So everybody's got to pay for food and shelter and energy. Now, how much they pay changes, right? But everybody's got to pay for those in some form or fashion. Either you have rent or you have a mortgage, or even if you own a property free and clear, there's still property taxes, there's still maintenance, there's still utilities, all those kinds of things. So if you make $50,000 and you have a family of four, your cost of living is probably $50,000, and that's just covering the basics. So if you have to pay tax on that at a flat tax, you're artificially raising the cost of all those basic life necessities. So whereas if you are very wealthy and you make $500,000, then your basic cost of living might still be $50,000, and the tax on that is kind of irrelevant for your situation because you have all this buffer room. And so that's what they mean by it being regressive, in that in terms of percentage of the cost of basic living, people who make less will end up having a higher net effective rate on their income compared to people who make more. And so, because of that, that's why we have a graduated tax system that as you make more, those portions that are higher and higher on the income scale, you actually get taxed more and more as along that spectrum. So the first money that you make is tax free until you hit the standard deduction. Then you pay 10%, then you pay 12%, then you pay 22%, then you pay 24%, then you pay 32, 35, 37. So so that graduation, that change in the scale as you go along is there to reflect that reality that the cost of living is fixed and significant. So yeah, so I don't see a flat tax happening in the US because of those issues, but there have been these proposals. I used to be a fan of the fair tax, which was a flat tax, but it was a sales tax based. So if you talk to economists, a lot of them will say that the best tax is a consumption based tax. So when you buy stuff to use, then that's the point at which you want to tax something because that is totally discretionary. So if you're super rich and you want to buy a yacht, then you're going to pay a whole boatload of taxes, pun intended, at that point because you're consuming a good. You're putting this boat or this yacht into service, and at that point it becomes a retail sale, and you're going to pay a whole bunch of taxes. And the way the fair tax dealt with the regressive nature is that everybody would get a monthly payment equivalent to the uh, the tax that would have been paid on the basic standard of living for your family size. So there's some administrative issues with that. It's like, well, my family size is four, and then somebody moved out, or we had a baby, or we got divorced, or all these different kinds of situations that are going to modify that family size. So it's kind of a hassle in that regard. But I think that's probably one of the best tax proposals I've seen over the years. But it's one of those things. As proposed, 20 years ago, something like that, and got a little bit of attention and then went nowhere. So um, I don't anticipate any major changes to the tax system. Even with Trump talking about tariffs, there's no way to There's no way to charge enough in tariffs to replace the income tax. And the worst possible thing that would happen would be high tariffs and having the current tax system. So, that's something to watch out for with this upcoming administration. Um, so yeah, overall, I actually think our system is one of the better ones, simply because it is so customizable to everybody's situation that you can really tailor things to you, rather than just being forced to pay according to one size fits all kind of tax policy. So
Alrighty.
so we're coming up on the end of the hour. How is the next one a long one or no? Can
Oh
we?
no, well, it depends.
All right, fair enough.
They just asked, it's a general question. They want to
Yep.
know, can you explain the difference between a tax deduction and a tax credit, and which
Yeah.
has a bigger impact on reducing taxes?
Well, it depends on the number, but yeah. So a deduction affects how much income you're being taxed on. So let's just take a business. Very simple. Business brings in $100,000. It has expenses of 50,000. Let's say, okay, brings in $100,000, has expenses of 80. That leaves 20, right? That $80,000 is deductible. Those are deductions against the revenue of the 100,000. So we're lowering the amount that is subject to tax. And there's all different kinds of deductions. Um, but so the way the math works is you have revenue, you have deductions, and then that creates your taxable income. And then you have your taxes assessed based on that. And after that, you have credits. So what credits are changes to the amount of tax owed after the tax has already been calculated. So let's say I owe $10,000 in taxes, but I've got a few kids, right, that are under the age of 16. So I'm going to get the child tax credit of 2,000 a kid. And so if I've got three kids, that's $6,000 worth of credit. So instead of paying the 10, I'm going to pay 10 minus 6. That leaves me with 4. Okay, so deductions hit the income first, then taxes assessed, credits, taxes assessed, and then the tax is modified by the credit. And there's different kinds of credits, there's different kinds of deductions. So all that goes into the consideration. As far as which is better, usually credits are going to be better on an impact basis, but that's not always the case. So again, it depends. Um, but most people are semi okay at deductions, and a lot of people miss the boat entirely when it comes to credits. So the credits everybody knows about are the credits for kids, although there's actually three credits for kids. There's the earned income credit, there's the child tax credit slash additional child tax credit, and then there's child care credit for daycare and aftercare and stuff like that. Most people have heard of the credit for electric vehicles and that kind of stuff that was revamped recently by the Inflation Reduction Act. Um, then there are other credits on the personal level for residential energy, like if you have solar, or if you put in a heat pump, or you have an energy audit in your house by your utility company, stuff like that. Um, but there are even more credits than that at the personal level, and then at the business level, there's tons of credits. So there's solar credits, that's a popular one. There's different kinds of energy credits for energy development. There's credits for providing low income housing units. There's credits for hiring people to work that the government wants to favor, like uh, the work opportunity credit. There's a whole list. Form 3800 has like a whole list in the form for different kinds of credits. If you run a restaurant and you cover your employees' social security payments, there's a credit for that. So it goes, on and on and on. And then, in most cases, those are going to pass through to the owners and then get deducted at the personal level, on the personal tax return. So yeah, there's all kinds of stuff out there, and some credits are transferable and saleable, and some are not. So the ones that are transferable, there's a whole marketplace out there, but you have to be talking big dollars at that point for that to work. Usually, that's like if you owe six figures in taxes and up, that's kind of where the credit marketplace starts to kick in. Um, But yeah, so that's the difference between the two. And the bottom line is that which is better, it depends on your situation, depends on what you have going on, depends on the numbers involved. But take both. That's that's really the answer. Take deductions to minimize the tax assessed, and then take credits to minimize the tax after it's assessed. So that's the upshot. All right, so that brings us close to the end. Um, I always like to leave people with next steps. Next steps is become an explorer. Go to taxsherpa.com/explorer or scan the QR code there, and that will take you to sign up for our free group. It's totally free. And you'll get notifications about this show. You'll get access to a lot of resources in our learning portal. We've had a bunch of people lately who have needed our partnership blueprint, where we have the 13 questions that you need to answer before going into partnership with somebody, and that's a free resource in the Explorers group. And um, there's stuff being added all the time. So I'm working on an S corporation workshop that is going to be coming up, and that's going to be free for all of our explorers. And you'll have access to things like the starter plan, which will be super cheap for explorers, free for our navigators, which is our premium group. And fundamentally, if you want to buy any of the things that do have a cost in the explorers, it's better just to join the navigators and just get it all for free. So that's the incentive to join the navigators, along with weekly calls that we do. That's private and not in this streaming format. But yeah, become an explorer, and you'll be up to date with all of the things that we have going on in the Tax Sherpa world. You'll be notified with workshops, learning modules. We have a forum, all that kind of stuff. So it's a good time. And I guess that does it for this week. So we'll do this all again. Well, actually, next week is this week is Thanksgiving, but so we will be off here at Tech Sherpa starting Wednesday of next week, but Tuesday we'll still be in the office. So we will have a show next week, same time, same channel, and we will see you then. So thanks everybody. Great to see everybody out here. And if you're looking for the replay, YouTube will have its own replay, but then later on, as we edit and trim down everything, then we'll post those as well. So